Hello, Frank. Thank you so much for joining us today. Can you please tell me a little bit about you and your company?
Sure. Well, Parnas, thank you so much for having me today. My name is Frank Bideau at Exchange Resources. I'm the Vice President for Orange County. And our company is what we call a qualified intermediary. We facilitate 1031 exchange for people. So that's what we do.
Okay. How long have you been doing this?
For many, many years, more than a few decades already. And our company has done so many exchanges. We do business all over the US. And
I have used them several times. Perfect service. I'm very happy with your services, very knowledgeable team, all that. So can you please tell my viewers what a 1031 exchange is?
Sure. So a 1031 exchange is basically a federal program, from the tax code that allows a taxpayer who owns investment property. When you sell that investment property, you're going to have to pay some taxes on the gain, right? Well, with the exchange, as long as you reinvest the proceeds from that investment property into another investment property, then the IRS, Section 1031 of the tax code, will allow you to defer the payment of those taxes. Meaning that rather than paying maybe 35–40% based on your tax bracket in taxes, you're going to save that money and reinvest that money for yourself in your own investment. Now, it has to be investment properties, right? Not a primary home or a second home or something like that.
Understood. Can you please tell me that what are the properties that you can exchange them with each other? Like, can I sell a land and then buy single family? Can I sell a condo and then buy a business, or like what are the properties that are exchangeable?
Sure. So when you look at 1031 exchange, there's something that refers to like-kind property. What do we mean by like-kind? It really means the type. It's not about the type of property, it's the use. How do you use that property? So investment for investment, right? It can be any type of investment. It can be a rental condo that you have. It could be that office building, a commercial property. It could be a vacant piece of land. It could be the hotel, not the business, because you cannot exchange into a business. But the hotel, the building, you could do that.
Okay, not business, but the building to building.
Exactly.
Okay, perfect.
So as long as it's income producing or land, vacant land, like I said, or real estate that is used in a trade or a business, right? That you use in your business, like a gas station or, like a hotel, like I mentioned.
Got it. The other question, if let's say I sell my rental property for $2 million, so what happens to my loan that I have for $500K on the property? How much should be the next property be in order for me not to pay any taxes? And can I buy something less expensive?
Sure. So, the 1031 is a good program, but there are some rules that comes with that. One of them is that you have to buy equal or greater in value to what you are selling. So I'm going to use an example. Like I said, let's say I sell for $2 million, right? It's going to cost me, I'm going to have some costs to sell that property, like commissions, NESCO, and title fees. Let's say it costs me $100,000 to sell that property. So I sell for $2 million. I can deduct my non-recurring closing cost. Leaves me with $1.9 million. That is the value I have to buy equal or greater to defer 100% of the taxes, right? Now, you mentioned a loan, right? Let's say I owe some money. Let's say I owe $400,000, right? So as you sell the property, that loan is going to be paid off. I'm going to be netting only 1.5, after the math. Now, if I only buy for 1.5, I'm going to be short by 400,000 because, again, the replacement value has to be the net sale price, not just the net cash. So as long as I buy another property that is 1.9, so of course I'm going to come to the table with only 1.5. Then when I buy the new property, I'm going to have to bring more cash. I can bring 400,000 cash or more, or I can take on another loan to come up to that replacement value.
But you have the option not to get a loan, but then you have to pay tax on that 400 extra.
Sure.
It's going to consider your gain. But you have the option to pay the tax, buy something less expensive.
Yeah, and that's what we call a partial exchange, right? So in that example, if I don't want to replace my loan, want to buy for 1.5, no problem. I'm going to be paying the taxes on the 400,000 I'm not replacing, right? Now, again, I'm not a CPA. We are not CPAs. Always talk to your tax advisor to, figure what the tax ramifications are going to be. But another quick point I wanted to make is people are under the misconception that they have to replace their gain, the profit in the property, or what they are netting from escrow. It's not.
It's a sale price.
It's a sale price.
Minus the cost.
Exactly. You got it.
And then the other question is that I know that I don't want to go through the timeline for this session, but I get this question that let's say I lived in my home for 10 years and then I rented it for the past couple of years, 2-3 years. Can I now still do a 1031 exchange? And what's going to happen to my $500,000 tax exemption that I have for a married couple?
Sure. Yeah, I'm glad you asked that question because this is something that people are unaware about, right? The LA Times, Parnas, had an article on baby boomers, right, owning those primary residence for many, many years, big houses, and now they are afraid to sell those property because of the taxes, right? So let's say you own you bought your primary home like, I don't know, 30 years ago. You paid $200,000 for it. It's now worth $2 million, right? So you have a $1.8 million in gain, right? Now, granted, because it's your primary, you could get what's called a 121 exclusion, right? When you sell a primary, if you're single, you get $250K tax-free. If you're married, filing jointly, up to $500,000. So yes, you can get the $500,000 if you sell that property. But on 1.8 million, after getting that $500K tax-free, you're still left with 1.3, and that's going to be taxable, right? Now, there is a solution for that, and it requires a little bit of doing something. But it's interesting is that if you move out of that property a couple years before selling it and convert that primary into a rental property, right, for a couple years, then what's going to happen is now you can sell that property 2 years down the road and do a 1031 exchange because the last 2 years was a rental. But the best part is, Parnas, remember that 121 exclusion, it says that if you own, going back 5 years, if you lived in that property for 2 out of the last 5 years, it doesn't have to be the last 2 years, then you still qualify for that 121 exclusion. So you can get both. So as an example, I'm selling for $2 million, right? Let's say I'm married, filing jointly. I sell my property after renting it for 2 years, get $500,000 tax-free, unless with 1.5, then I would have to do an exchange on the 1.5 left over. Again, this is a simplified example told to your CPA, but that's a great option for people with that concern.
Understood. Okay, perfect. So now maybe you can let us know a little bit about the timelines. So maybe next time we talk more about the timelines. Just give us a short overview of what are the timelines for identifying the properties, how long people have to find them, how long do they have to purchase them.
So again, that's another rule, the timeline, right? So you have to set up your exchange before closing escrow. That's important. But the clock, there is a clock, and that clock's going to start the day you close escrow. So from the day you close escrow, you're going to have 6 months or 180 days to complete your whole exchange. The first 45 days of the 180 is to identify, basically on a form that we provide the taxpayer, a list of properties that you're intending to buy. So you have 45 days to identify that replacement property. So I understand it's all tight, so you need to be proactive, right, and start the process.
And that timeline starts when the escrow of the first property closes. So it's very important to plan ahead of time, maybe, find some replacement properties before your escrow closes so we don't have, to stress about finding a replacement property. So those are the little details that, we work together to help my clients. Just wanted you to just give them an overview. Okay, thank you so very much for your time today. Next session, maybe we get to more detail for the reverse 1031 exchange and for all that good stuff that you can help client with. And also you mentioned something about the no hassle in reinvestment of the properties. So what do you call that?
That's a DST, Delaware Statutory Trust.
Okay, so maybe next time we are going to talk about that. Thank you so very much.
Thank you,
I appreciate your time.
Thank you.